We've got to go to the swoosh. Nike withdrawing its full year guidance and postponing its investor day scheduled for next month ahead of Elliott Hill taking over as CEO. The company reporting mixed first quarter results, beating on earnings, missing on revenue. Joining us now for more of a read on this, we've got Baird senior research analyst Jonathan Komp. Jonathan, great to have you here with us. Just break down the tenor that you heard from the company pulling some of their guidance here. It was essentially kind of a look across the board and saying the environment is competitive and it's going to take some time for them to really make inroads and expand market share at this time. What do you make of that?
Thanks, Brad, for having me on this morning. This really was a transitional quarter for Nike. The call itself was led by the company's CFO. And as you mentioned, I think we're now 12 days before incoming CEO Elliott Hill is set to join the company. I think the results, if you look at revenue down 10%, earnings down more than 25%, really highlight some of the pressures in the business currently. You see Nike taking proactive actions to reduce classics footwear inventory in the marketplace. That's had a significant hit. And then, frankly, you've seen lower than expected unit demand in a couple of places. The company called out back to school in North America, as well as the retail conditions in China, both as some incremental challenges. So maybe no surprise that you see the reaction from the stock today. We did lower our forward earnings by about 10% overnight here, but really we're focused more on the outlook ahead as new leadership starts to take over.
And Jonathan, what is it about Nike's playbook that's getting you excited? Because your note out this morning was called titled Positioning for a Comeback Story. I guess why don't these weak results and some of those trends to the downside that we've seen, why isn't that deterring you at all?
Yeah, it's a great question, Shauna. I think a couple of things that we try to factor in. First, generally, we expect stocks in the sector to bottom when earnings start getting less bad. We think we've seen the worst here for Nike, but it is going to take patience looking forward. We think Nike, over the long run, still has exceptional brand equity and value. We think the last 4 years really have been clouded by misexecution on a number of fronts. And new CEO Elliott Hill really is more of an insider than not. He's a 32-year veteran at the company. I think he's very well liked. The positive signals are pretty clear from an internal perspective, and that's important for a company that's not used to being on defense. As we look forward, the company already is taking actions to build the innovation pipeline. Really performance innovations, what has led Nike out of past challenges when you look over the past few decades. We expect that pipeline to start to build in 2025 and beyond. And when we look today, the earnings look very depressed and we think have significant upside potential. So forward-looking investors who are willing to be patient and see the potential benefits under new leadership, we think can be rewarded by starting to take another look here.
It's really interesting, Jonathan, because when we think about performance innovation, that typically comes with a cost premium for any athletic apparel and footwear company. And so you still have this backdrop of a consumer that is being very choosy about how they're spending and what they're spending on. How difficult is that going to be for Nike to make sure that they are striking the right price and making sure that any innovation that gets put into the market for consumers is actually appreciated and is actually recognized in sales?
Well, you're exactly right. We do see a challenging near-term environment. We've seen consumer spending slowing pretty consistently across the board. In addition, Nike's not operating in a vacuum, and there's certainly lots of competition. We see that from Adidas. We see that from some of the upstart brands, whether it be Hoka or ONON. So it's a competitive category. The good thing is we do think the category can continue to take share over time. We think Nike can regain its leadership position. And if you look over the last few years, really, Nike's become a bit unbalanced. We think there's significant opportunity left on the table, reengaging wholesale partners, and especially some of those that cater to lower price points specifically. So we think there's opportunity across the board for Nike, but it has to start with product, and it's going to take some time to scale that back up. And when they do that, we expect it to come really across price points. So that should address multiple consumer categories in the marketplace.
Just lastly, while we have you here, as you think about Nike's history, it hasn't had a rich acquisitive history, but very strategic. And in periods like this, I mean, and some of that has meant divestitures over time. Do you think that this is a company that needs to make a strategic acquisition in order to bring on more market share for its business?
Yeah, it's a great question. Certainly a typical playbook for others. I think for Nike, focusing back on the core business really is the right move here. If you look at our forward projections here, we're essentially modeling profitability back to 2016 levels. And that's despite a company that's now nearly 50 billion in revenue versus closer to 30 billion back then. So we think there's significant potential just by being a better run company, getting back to higher profitability and resonating more with the consumer. That's again going to take time, but really nothing that we see that would require acquisitions in terms of bringing on new brands or capabilities.